Bajaj Auto is the one in focus. Kevin Desa, CFO at Bajaj Auto, joins us on the phone line from Pune. Kevin, hi, afternoon. First, a clarity on your EBITDA numbers, because your EBITDA, as per the profit and loss, balance sheet stands at about 920 crore rupees. But in the results release, Kevin, it's mentioned 972 crore rupees. So what is this 52 crore rupee adjustment relating to? Because 20 crore rupees is the forex gain, which is included, but what is the rest 32 crore rupees accounting for?
You see, the revised Schedule 6 that has come out has the other income figure, which now includes the figure 140 that you're seeing, includes treasury income, as well as what I would say normal operating income. If I have to break up the 140, 88 is pure treasury, which we have never considered as operating, and the other income, which is basically forex gains on realized gains, that is 52. So that in the past, and all along for so many years, we have been showing it as a part of operations. But in the revised schedule format, this is required to be shown as other income, hence the difference.
Right. Kevin, for the quarter, while your EBITDA margins are probably a little higher than the street estimates, analysts are expecting that due to the changing sales mix, margins for your company will remain under pressure going forward. Would you agree with that view?
See, quarter is very difficult for someone to just give a guidance, etc. But what I feel comfortable is seeing that if you look at the last year before last, that's 10-11, our EBITDA margin was 20.7. In the current year, that's 11-12. By and large, we have been able to hold on to the margin of 20.2. As far as going forward is concerned, our attempt, of course, will be to maintain the 20% margins. And as a part of the company's basic philosophy is we do not buy market share by sacrificing margins. So while I will not say that we will maintain 20%, I think for me at this particular point of time, 20% is a doable figure. But these are early days. There are a lot of headwinds that you're seeing. You're seeing headwinds on the export side because of the Sri Lanka price increase. You're seeing the domestic demand, which we are seeing almost sluggish. And there definitely are headwinds. But 20% is what I would say a figure that we would like to gun for.
Kevin, just to stretch that point forward, analysts were expecting that due to the changing sales mix, your margins are going to remain under pressure. A, do you think this trend is going to go forward as the demand for premium bikes as well as three-wheelers is going to remain weak for you? Because three-wheeler in any case is one, eyesore of sorts. Each time we've spoken with you, you've always indicated that this particular segment is going to continue to be under pressure at least for the next 2 to 3 quarters.
You see, the point is that, yes, three-wheeler is a very profitable product. It does contribute as a margin in a 30% plus EBITDA. But one should appreciate that over the period of time, what has happened is the company has moved significantly away from the low-end motorcycles to high-end motorcycles. So to share with you, for example, the Pulsar family gives an EBITDA margin of 20% plus. As far as when one is talking of the commercial vehicles slowing down, one is talking only of the domestic part of the business. Now, three-wheelers, domestic, just contributes 8% of the total turnover. So my EBITDA margins moving are significantly changed will not really depend so much on the three-wheeler, but will also mean as a combination of all the products put together. So it would be unfair to pick up one particular product and say that this is going down, therefore the EBITDA margins to move on. So this is the way I would like to look at it. For us, the exports, touchwood is doing well, domestic is doing well. We have just launched 2 good products, that is the Pulsar NS 200. We have just launched, Rajiv has displayed 2 days back, the Discover 125. All these products, I think, will give us scale, will give us market share, and will enable us to leverage operating costs. And hence, I would still at this point of time, like I'm saying, I'm not giving a guidance. 20% is something that we would like to aspire for.
What about the competitive intensity in the market, Kevin? Because analysts believe that FY13 is going to be a key year because Honda will be in full force, would have settled down in the market as well. What is your sense of the competitive intensity in the market in FY13?
I would say that there are 2 parts to the way I would answer this question. One is the demand and second is the capacity and the competitive intensity. Demand is definitely slow. The first quarter, I would say that for the quarter ended June, I would not see a growth of more than 6%. And I would say that even if I take the full of the half year of the current year, I would estimate the growth to be about 7 to 8%. This is one part. The second part is the competitive intensity with Honda coming in, with Hero coming in. This is definitely there. The competition will intensify. All those things happen. But the main point is do you as a company have the desired capabilities in-house to handle the competition? Do you have the technology, the backup? Do you have the cash in the balance sheet? Do you have the management bandwidth? Do you have export markets available? Do you have all these sort of weapons to handle the competition? I think if I look at it that way, we are very well placed.
Kevin, you just talked about as to how your export front has done pretty well. Could you throw some more details on how the region-wise breakup has been?
By and large, the growth has come from Africa. Africa we do approximately about 40% of the sales comes from Africa, 40% plus. Then there's about 20% coming from Sri Lanka, Bangladesh, 17% from Latin America, and the balance is from Southeast Asia. We see Africa and these markets pretty okay, but as you would have known that in the early April, Sri Lanka has jacked up the duty rates for all imports of vehicles, especially three-wheelers, motorcycles and cars, significantly, resulting in the end cost of the customer going up to almost by about 40%. This, I would say, is definitely going to be a bit of a initial problem, and I would say for the next 2 months, that's May and June, one should see a little bit of a slowdown in the exports from Sri Lanka to Sri Lanka. But again, my view is this is temporary. The shock will absorb. There are no alternatives that is there. So I think it's more a situation of a delayed export rather than a lost export.
What about the commercial vehicle segment? That's seen a bit of a disappointing growth. Do you expect some sort of a revival in demand for that segment going forward?
I am cautious on the commercial vehicle domestic. But if I take the commercial vehicles in totality, I'm pretty okay. Barring the Sri Lanka episode that we see, which will be a delayed exports, in totality, I would say that the commercial vehicles, which currently about 60% is exported, the growth story in export remains strong. But again, with the rider, there'll be a delay for 2-3 months on account of Sri Lanka. And domestic market is definitely slow. I would estimate a growth rate of about 5% in the domestic market for the industry.
Kevin, what about the RE60 launch? Is that on track for Sri Lanka?
Is very much on track. I won't say whether it's for Sri Lanka or for India or anything. I won't get into that discussion. Is very much on track and is expected to be launched in the fourth quarter of the current fiscal.